So why does due diligence matter? Why conduct any due diligence around revenues, before you sign that purchase agreement? Ultimately, conducting due diligence protects your investment and it looks to limit the risk associated with the particular investment. When it comes to small business acquisitions, which are unaudited, there is an inherent risk that goes behind the investment. So if you think of an investment, such as a stock or investing in a home or maybe a Airbnb or a second home, there is risk that the home price will decrease in value. There is a risk that your stock may decrease in value. The same applies to buying a small business. The challenge is it's significantly riskier, and I'll explain why. When you're buying a small business, which is unaudited, it largely has never been verified from a financial health perspective. So the company will show revenues, they'll show costs, and they'll show profitability. And then likely the owners of the company will say things such as, well, I take home typically $200,000 a year, I take home $1 million a year, etc. All of those things are just numbers that need to be verified as truth. When we flip to stocks or homes, a stock is audited and you can ensure that the stock of the company is being conducted accordingly based on the audit complete. In small business deal making, there is no verification that the revenues, expenses, and net incomes of the company actually exist. So conducting due diligence at the core of it is verifying the financials of the company. So if the company says it produces $1 million in net income, going into the accounting records and verifying that is something which is the first part of this financial due diligence equation. So when it comes to the customer piece, um, you know, typically where you fit in the process, and I'll go ahead and share my screen just so we can kind of flip through it. Um, and if you have any questions during this, feel free to throw them in the chat. I'd love to talk through them. Um, so what you should see on my screen is the customer relationship analysis. Um, if someone from my side of the house could confirm that that's what they're seeing, that would be great. Uh, so when we think about the customer relationship analysis, it's really broken into four pieces. It's what is the sales stability of the customer base? You do this by examining the consistency of customer purchasing patterns over time. Is the company getting more customers each month? Is the company losing customers each month? Understanding if the company has seasonality. Does the company have um, concentration? Is there an over reliance around the company's customer base, etc. What is the relationship strength of the customers? What does that look like? Have the same few customers been around for the company's entire existence? Is it relatively new? Those are some key things as well. What are some trends? So understanding the diversity and the mix of the customers. So tracking whether the customer base is becoming more diverse or more concentrated over time is also really important. These are just a few things to kind of set the stage for the customer analysis, and why it matters. So When we think about the customer concentration analysis, it's really to understand revenue distribution across the customer base and to identify if there is a risk for high customer concentration, because that can leave the company vulnerable and impact valuation. So, a couple things before we jump in. When it comes to revenue concentration, uh, when I think about customers, I like to plot out a top five or a top 10 customers. Typically, customers with revenues greater than 15 or 20% of total revenue pose a risk to the business. In aggregate, it might not be as material, but thinking about the percentages is a good way to set the stage when you're doing this preliminary analysis. When we think about customer retention, this is how long is a customer being retained by the company. And this speaks to if you're looking at a business that has monthly revenues or recurring revenues, there's two key phrases. So it's MRR, which is monthly recurring revenue, and ARR, which is annual recurring revenue. If your business has project based and doesn't have like a monthly fee, this is largely not applicable. But understanding the lifetime value of the customers, regardless of a subscription or not subscription type business, is very important when you're doing this preliminary analysis. So assess the margin quality by customer. So what do I mean when I say that? The profitability analysis, which is what I call the customer by margin analysis, it looks to show, okay, so what are my revenues by customer? But more importantly, how much money am I actually making from a profit standpoint for the customer base? Because if you have a customer which you actually may be losing money on, or it's a break-even endeavor and with labor you're losing money, you need to be made aware of those things because those types of customers might not make sense for you as a new buyer. For example, high margin accounts, the top three customers in this instance were generating 45% of gross margin through premium pricing and efficient service model deliveries. Um, some of the pressure points around that is it looks like the company has been doing a good job serving three customers with premium pricing and products. The question is the rest of the customer mix not taking, is the company not able to sell those premium high ticket items to the rest of the customer pool? Because if they're not, um, those customers could be actually outside of the normal type of customer. And you can make a case it's not likely those high ticket customers could be either obtained by the company, as you transition into the business, or if you lose those high ticket premium pricing, the company's financial performance could significantly decline. So these are what I call margin pressure points. So it's basically what the pressure points of the business are. You have a customer pool with potentially on paper, the company has high margins, but it's derived from two or three of the top customers. The top customers with high revenues are also highly profitable because, it says 45% gross margins from this premium product delivered. Um, the risks of buying a business like this is likely the sellers of the company have leveraged these higher ticket items to boost profitability. And based on the performance of the company, they thought it was a good time to go to market. The challenge with you coming in as a new buyer is you need to assess, is it reasonable to assume these high ticket customers will stick around post close? And what does life look like, when I transition as the new business owner? So that's profitability analysis and some key kind of highlights. Uh, I did want to jump into a case study. So when we think about customer retention analysis, and I'll do my best to get me out of the way and share my full Excel screen. So just bear with me 1 second. Um, there's a lot of different analysis you can do when you're conducting financial diligence. So one thing I like to do regardless is set up what is known as a cohort analysis. So this cohort analysis looks to do a few different things. Uh, it looks to show what does the customer count look like on a month-to-month basis. It looks to show what is the lifetime value of the customers over their typical life cycle. So in this instance, it is a company that has a monthly subscription. It's a SaaS business, but this can largely be applied to non-subscription companies as well. Doing things like the customer count. So you'll see here, the customer right here is the customer cohort. You'll see it starts with plotting out the customers by month. So this can be obtained from a sales or POS system. And you'll see that in April, uh, the company had 85 purchases in April. So month zero, which is how this graph starts, and if you follow along the orange dots, those were the actual purchases in April based on the month life cycle. So for customers who purchased in January, they're in the green box, and you'll see that after month one, these January customers, there were 35 more purchases, 30 in month two, and then 30 in month three. Month three being, i.e., month four. So that's sort of how this graph works. Let me give you a couple key findings. And this was analysis I did for a company, and I stripped it down to make it a easy to understand example. So the customer retention by cohort, this looks to see what is the churn and the customer life cycle of some of these customers as they come in. So you'll see in January, February, March, and April, they had about 74% of the customers were retained. It's okay, but you'll see by month 11, only 26% of those original customers were still around at the end of the period. Um, on the flip side, if we double click on June, in June, by month 3 or 4, the company had 95% retention for the customers. So if we compare it from January to June, the company did something differently to retain these customers and prevent churn. So the question is, what do they do? So this is an analysis that I will conduct early on in financial diligence, and I would ask them the question, what changed in June? What changed in June? June, did you run a promotion in June where you had something like 1 month free or a 15% discount if you locked in for 3 months? Because typically I wouldn't expect the retention rate to be 95%. So something has changed. Maybe they brought in a few more customer service representatives to better communicate with the customer mix, and there was an overall higher sentiment with the product being delivered month over month. These This analysis and any revenue analysis you conduct is to be leveraged for conversations with the company. So if we take a step back, if you're a prospective business buyer looking to purchase a small business, any analysis you're doing is to be leveraged as a talking point with the sellers as you learn more information about the company. So in this instance, uh, the company ran a marketing and advertising promotions for discounts of effectively if you lock in for 3 months, you were able to receive 15% off. Um, so that was sort of the drivers of this. In addition, they hired a few more customer service representatives, which overall led to less churn uh, in those months. So that's the customer retention by cohort. We'll keep it moving and we'll move into probably the most important piece of this. So a lot of questions I get is what is the net margin by customer, or how is the company performing month to month, year over year compared to 2024 compared to 2025? So there's an analysis called the net dollar or net revenue retention, which effectively looks at the revenues by month and compares those um, to the revenues earned month to month. And you'll see that for percentages above 100%, that is what is known as expansion revenue. So this is very favorable for companies and analysis, regardless of the type of business you're buying. This is an indicator that um, there is a incremental increase in customer revenues of the existing base. So think add-ons, um, you know, different initiatives to boost customer revenue month to month. You'll see in the March cohort, after month one, the net revenue actually increased. Yet the customers remain the same. So within this March cohort, I'll say that again slowly, 22 people signed up in March. On month two or month one, the same 22 renewed and did not churn, but something happened where you were able to increase the revenues by that cohort. So one of the customers elected to have an add-on service to increase their monthly revenues. So that is called, expansion revenue. So it's expanding on the original revenue offering month to month. So this is very favorable. On the flip side, if you see items that are under 100%, it is due to a factor of churn, some customers electing to reduce monthly revenues, etc. So that was an interesting thing when I was looking at this analysis. The company rolled out some initiatives to do some add-on services, and you'll see here that it hasn't been that successful, but in this month it happened to work with one of the customers. So moving down the line, um, the customer lifetime revenue is an interesting one. So the cumulative lifetime revenue is an interesting analysis because it looks at what is the expected lifetime revenue of a particular cohort or customer over, the original offering compared to 11 months into it. So you'll see here, and it's highlighted here, in January, the January cohort spent about $1,750 in total revenues. So again, it was the original pool of 35 customers times the subscription of $50. So relatively small. But if we go through the life cycle of this singular cohort, by month 11, that revenue has increased to 14,200. Significant. I do like to call out that those are compounding rolling monthly revenues as well. So if you think about $1,000 subscription by month 11, it would be at 11,000. But it still does show you um, sort of the revenue growth of these customers from a $50 subscription. If you apply this to larger businesses that might have $500 subscriptions or $1,000 subscriptions, these numbers can be pretty large quickly. The most important piece of understanding the lifetime revenue is double clicking and understanding the customer lifetime revenue on an individual customer. And the reason why this is important is this shows one customer how much revenues it will give you over a 12-month time frame. So again, if we start in December, or if we start for a customer who signs up in January, they pay us $50 in January, $100, and then if we plot out the entire year, on average, the customer will spend $406 over a 12-month period for one customer. So why is this metric important? This metric is important because if we are running ads and trying to understand what is our customer acquisition costs, hypothetically, let's say our customer acquisition costs were $115. By month 3, we have broken even and are starting to become profitable with this customer. And the rest of it is pure profit. So when you're looking at customer lifetime revenues, month-to-month changes, breaking it down into the life cycle of the customer and the profitability is very important. You want to see customer retention high. You want to see instances of expansion revenue, which shows that the company is actively trying to do add-on services and increase revenue over the lifetime value. And then you want to see what is the actual margin and what is the profitability of these customers. So this example assumes the company is producing 65% gross margins. So for every $50 monthly fee, the company is profiting $33. Over a 12-month period, each customer will bring in a profit of $264. So we had a question that come in, and it's a good one. When I was learning the drivers of cohort, it tripped me up. So it said, can you clarify again why month is used to define cohort? So it's just a group. You can think of a cohort as a group of customers who all sign up in the same month. So you'll see here in April, customers, there were this many customers who purchased in April. Purchased from either the January months or February, March, or April. If we just focus on January to keep it simple, in January, the January cohort will be folks who signed up in January and paid their subscription in month 0. So it's this horizontal analysis, which is important because it shows what is the customer count from the original base of 35 to what does that same base look like in month 11 or 12. You'll see that in month 35, they had 100% retention. But by that month 11 or month 12, there's only 26% of that original pool. So it's important to look at churn by customer by the month of signing up. And then also you want to see the revenues earned each month. So it's almost a horizontal analysis as well as these color codes. So it's a little confusing. But this chart kind of shows a good example of, those 100% customers moving to 26. Flipping back to some of the profitability and things we think about. I What are some of the, where does this fit in the financial due diligence process? So where does the customer analysis fit? Typically, when you kick off financial diligence, you want to assess these in the analytical procedures. So if we zoom in on here, we would be analyzing historical financial performance, analyzing trends, um, and revenues, and customers. This also goes hand in hand with the income statement review. So it'll assess the per product, per customer profitability. So that's where this fits in the ecosystem. You'll see if we zoom out, there are several um, layers of this analysis when it comes to financial diligence. But in my opinion, understanding the revenue quality, which is a lot of what we just covered, is critical. So for those of you who are under contract and looking for a data request list, I put together a financial due diligence checklist. If you want to scan the copy, you can automatically receive yours today. This is a jam-packed spreadsheet, which I use on every deal. It'll show you what documents you need to request from the company. So feel free to scan that QR code. And while I give you a few seconds to do that, I saw a few more questions kind of come up in the chat, so I'll address those right now. So one of the questions I got was, um, when should you conduct this detail of analysis? I may be searching for a business with limited information. How do I think about conducting some of these analysis before going under LOI? That's a great question. So really appreciate it. You can ask for things like um, customer data without the names of the customers or customer counts, or you can ask for any revenue if they're willing to share. Unfortunately, until you are under LOI, a lot of the company secrets, I call them, likely won't be shared with you, because rightfully so, the sellers will be cautious to provide that information. But I would focus on things like revenues, trending revenues month to month, especially year over year, because if revenues are declining or month to month revenues are, not performing well, any sort of detailed revenue analysis likely will say a similar story. It'll just be different numbers and equations. So that's typically how I think about the pre-LOI diligence. Once you are under LOI, I think we had one or two folks who said they were. I would request customer reports, sales reports, invoice detail, etc., to do some of these analysis. When we think about the performance, performance by entity, that's another analysis I will likely do. Um, you'll see here in the chart, which I'll pull up right now. If you're buying a business that may be multiple entities or may have, if you're buying two service lines which hold different QuickBooks accounts, you want to assess the concentration amongst it. And what I mean by that is, what are the revenues of each of the entities of the company you're buying? Okay. He's gonna get it. We'll come back to that one. So flipping over to the revenue entity analysis, typically it will look like, this. So this is an example of top customers. Imagine this top customer list, customer one, two, three through 10. So if we zoom in on this list, you'll see that the top 10 customers roughly comprise 26% of total revenues. In my opinion, that's a very healthy customer mix. You'll see that um, customer one and customer two are really the only ones with significant revenues, like 5% of total. But in large part, especially for small businesses, this is actually a very healthy customer mix. Um, when you do receive the financial data, what I'll do is I will put together a customer list like this, because that'll show, what is the company revenues look like, and then where is the company getting those revenues? Additionally, putting together something that looks like what is the year-to-date performance analysis. So this is a typical trend chart I'll put together. You'll see here it plots out the total revenues in line with the current client base that are active over the last, trailing 12 months or closed fiscal year. In this instance, you'll see that revenues are remaining relatively stable month to month. Certainly, there's some fluctuations, increases and decreases, but overall, the active clients are actually increasing, which is very favorable for some companies, especially those focused on that monthly recurring revenues. So this is a good snapshot to use for investors. So if you're looking to raise equity for some of these small businesses from LPs or capital groups, putting together analysis like this is going to be almost required in order to raise funds. This is something I work hand in hand with a lot of my clients. So if you need help with this, feel free to reach out. A lot of this is pretty simple Excel work, but it can be daunting for some of those who haven't done this level of analysis. So if we zoom in here, you'll see that the active client base goes from 82 to 98. So they picked up about 16 clients, as well as they probably had some churn. They averaged about 90 over the period, um, with monthly recurring revenues of 125 to 137. On average, it was about $135. Again, doing a customer count analysis can be important. So you'll see if you plot out customers um, who are added, so new ones and then losses, this can show you again what the customer mix looks like month to month. Again, these are tools to use for talking points when you speak to management and the rest of the company um, when you're doing this analysis. So a few more things to kind of think about as we wrap is when you're doing some of these revenue analysis, here is some of the process I look to do in all my analysis. So I call it the red flags and key insights report, and it's really like a four-step process. The first is you want to be able to analyze and detect the fluctuations and anomalies within the financial data. The, Ask yourself, what are the root causes of the analysis I'm looking at? Um, is revenues performing well month to month? Are they beginning to decrease? Like, what does that actually look like? Um, you want to recommend and think about what are some of the strategies and analysis I'd like to conduct after dissecting, what does the financial data look like? And then from there, after you've detected and analyzed, you can request some of these data documents to conduct, the net revenue retention analysis, conduct a customer analysis, etc. Until you go through this process of analyzing the data and then moving thoughtfully throughout your due diligence, you probably won't get to some of the answers you need. Um, this is a lot of where financial diligence teams spend, especially mine, in arming you with knowledge and insights into what are some of the key drivers of the business. Are customer accounts declining? Are they increasing month to month? And why does it matter from a dollars and cents standpoint? Some of the red flags to watch out for are unexplained revenue spikes or decreases. Declining margins is another big one. So many people who I speak with and when I conduct these acquisitions, they can follow the revenues and those changes month to month, but they aren't focusing on the margins of the business. And in my opinion, the margins actually tell a better story of how the company is performing. So why is that? Um, I'll give you an example if I have one offhand. So the margins of a company will show you how is the business performing month to month from a profitability standpoint. So if we head over to the income statement, and this is an example income statement, you'll see that when I look at a company's P&L, I like to immediately go to the margins of the company. So you'll see over a 4-year period, roughly, the company was producing 25% net margin in 21, 9% in 22, 12, and then a 29% in 2024. Um, so what changed with the business? Because all of a sudden, this business, which has roughly the same incomes, at least in 23 and 24, is significantly more profitable. So by starting at the margin analysis and looking at the net margins month to month or on an annual basis, you can start to develop a plan and a question list of what do I want to ask the company about? My first question for this deal was why did the company produce similar revenues year over year, but is significantly more profitable? And that would be, twofold, reflecting back on this. One, you'll see that the cost of goods sold declined slightly, about 70,000. But more importantly, the company is using less operating expenses. So something in their cost pool changed favorably in that they were able to produce similar revenues with less costs. So the point of this is when you're looking at a company and you see the net incomes or the profitabilities, the first reaction is to think, well, the company must be performing well, and people associate performance with top line revenue, but that's not always the case. It could be they cut costs and are therefore profitable. Um, they could have expanded revenues, like we just talked about, the expansion of revenues in customer base. Um, or there may be an accounting issue with how these costs were recorded. And that's much more of a financial due diligence topic, for a later day. There could be scenarios where the company changed accounting methods or are um, changing how they record costs month to month. So working with a CPA or a due diligence team, their first initiative would be to make sure that they're properly recording these costs in line with how they did in prior periods. This is a lot of information around it, but this is how you as a prospective business buyer should be thinking about margin analysis, what to do in the process, and how someone like myself, who's conducted over 1,000 deals, thinks about these types of businesses and conducting this thorough analysis. So in closing, that's a lot of the customer analysis. We could do a deeper dive into how to calculate the various analysis of net revenue retention, the customer analysis, et cetera. But that's going to be for, a later day. If you have any questions around this, this plotting grid, et cetera, a lot of these free templates can be accessed online. Um, this is a good way, if you're interested in something like this analysis being conducted, feel free to reach out to me for a prospective acquisition. Um, in closing, conducting a proper cohort analysis can be quite time consuming. You'll see in this tab alone, there's about 6 tabs to get to this final analysis, but it does show you the health of the business. It shows you what does the customer retention look like. Um, and it'll begin to give you the knowledge about the company. Is this the type of business I want to own where the company has significant churn? If you think about onboarding and offboarding clients, it can be quite time consuming. On the flip side, does the company have churn? Yes or no? These are really just to arm you with the facts around these types of acquisitions. Um, when I think about my business and investments, I focus a lot of my efforts in the lifetime value of the customer when it comes to pricing. So regardless of the industry you're in, you can see and you should conduct an analysis that shows, what is the first ticket fee I'm collecting from customer A? Uh, and then how much is customer A paying me over, a 3-month life cycle, a 3-year life cycle? Because that'll show you, is the company pricing correctly? Could there be opportunities to price it differently, etc.